A bumpy road ahead of us if you ask Jason Pride. He is Director of Investment Strategy at Glenmede, where he helps oversee $20 billion in assets. Jason, welcome to Close on Street Smart. I'm looking at, your research, your comments here, and you're basically saying we are going to hit some bumps in the road here as we go forward. We're in an expansion, but the government has sort of led us to this point with stimulus. Now they're cutting the stimulus off, trying to pass the baton, and that's just going to lead to some bumps in the road, right?
Right. I mean, this is a difficult transition that we're going through. We have been through the recovery. I think we're now in expansion. I'm defining that simply based on real GDP starting to tread to newer highs, and that's going to be an ongoing process. But now we're taking away some of the fiscal stimulus. We're moving towards fiscal austerity in this nation. Europe's already there. They're probably going to be doing more now because of Greece. And all of that is a weight against the activity of the economy. It doesn't mean that it's overwhelming and will shoot us into another recession. I don't think that's necessarily the case. But we've definitely slowed down enough, and majority of the indicators that we look at are pointing to exactly that at this point.
So what does that mean for your investment strategy? I mean, if you're concerned about a slowdown, the possibility even of another recession, do you pull back here?
So what we've done is we still have generally the same stance that we've had before, where we're underweight fixed income hugely, mainly because we don't see those yields providing good long-term returns, and we're looking at that from a long-term perspective. But when you look at how you're positioning the rest of the portfolio, you can take a different approach. We've pulled in our horns a little bit in order to bring our allocation into more neutral territory, and we've done that basically by utilizing what we consider to be non-traditional protection strategies, options-based strategies, hedge funds, things other than fixed income that give us that protection without giving up return.
Jason, you sound a little, you like stocks, you like equities, but I want to bring someone in who actually seems to like equities an awful lot. BlackRock chief Larry Fink confessing his love for U.S. stocks on Bloomberg Television earlier today. Listen up, everybody.
We love equities. We love dividend stocks. You own treasuries because you're worried about the world and the future, maybe a la Mark Faber. But if you believe the world is a good place to invest over a long cycle, you have to be in equities.
So I guess what I was trying to get to, Jason, you kind of sound lukewarm on equities. Am I right? I mean, Larry Fink seems to like equities big time here.
Look, we like equities for a long-term investment allocation for clients. What we've done is we've simply inched down the risk exposure down to more normal territory as opposed to being higher. When we saw the economy expanding and expanding more rapidly, we were pushing higher with higher equity weightings. At this point in time, we see it being more modest. We see a number of bumps in the road, and therefore we've just dialed down the risk exposure a little bit on a near-term basis. That can change once we have some more stabilization and give this slowdown time to work through all the economists and strategists' estimates, which it hasn't done so yet.
Sheila, do you have a question here?
Yes, Jason, it's Shelia Dharmarajan here from the newsroom. One of the bumps that a lot of people are talking about going forward is emerging markets. I mean, we did see emerging markets rebound today, but certainly it has been a rough couple of months for them, particularly, I mean, if you look at something like, Bombay's Sensex Index, rebounding today, but, clearly had a rough ride. And a lot of, growth expectations have been ratcheted down, a lot of inflation concerns. I know emerging markets is a part of your theory in terms of, strong U.S. equities with exposure to those markets. How are you telling clients to position themselves against some of those risks going forward, and how is that affecting your thesis?
So you have to look at emerging markets in two ways. Number one, it is a higher beta, higher exposure, higher economic exposure area, and therefore you will feel some of the impact from that. But having said that, you have to look at how they've been performing and how their economies have been performing. They tightened first. They felt the economic weakness first. They're finally starting to see a pullback in the food inflation prices that are coming through in their areas, which is the primary component. They're likely in the last innings of the tightening as opposed to the beginning innings. This might be yet again another one of those weird scenarios where emerging markets stabilizes out and actually moves upward before the other markets, the more developed markets, do. The headwinds facing the developed markets are still pretty considerable and still in the early innings.
Julie, I want to bring in you here because we had a really interesting story on the Bloomberg that seemed really bullish. Stocks are cheaper than junk. What's the story and what does it mean?
Well, bullish for stocks maybe, but not necessarily bullish in terms of risk. And this is kind of alludes to what Jason was talking about, some people pulling in their horns, him included. So basically what we've seen is this stretch of declines for the S&P 500 has left valuations at the lowest level ever compared with speculative grade or high yield debt. So if you look at the two, you can see sort of the trajectory that yes, high yield debt has come down as well. Stocks have come down, though, as profits have still been climbing. So that means the valuations are looking relatively attractive. Jason, I guess what this brings me to is I'm curious where you are on the credit side of the equation right now. Have you been avoiding risk there as well?
So we've definitely been taking risk on the credit side. We're positioned in high yield. You know, what you're seeing there, I think, is the difference between equities and fixed income. Equities are still reasonably valued, whereas almost everything in the fixed income asset class is extremely overvalued, or at least modestly overvalued. High yield, I think, is actually one of the more attractive areas still within the fixed income marketplace. So for investors that need to have a fixed income portion, we're recommending actually a fairly decent slug to high yield and then an allocation to equities as well.
I want to know what you think about commodities here. I mean, I know you like stocks that are connected to the energy sector. What do you think about commodities in general?
I think you have to be careful in commodities now. It's not everything's going to be rising and flowing upward from this point forward with commodities.
Because of a slowdown in demand, or?
We've definitely reached valuations that are more on the higher side of the equation. Now, by being careful in commodities, I mean you can still act in commodities, you can still get that inflation protection in commodities, but you've got to do it in a very specific way. You have to avoid very overpriced commodities like, I think, gold, and perhaps even oil to some degree. And you have to be investing in commodities that have extremely low inventories so that you can get those price spikes when the inflation comes.
On that note, I want to bring Adam in here because you always follow the shipping business for us. And I noticed a chart of the day here having to do with cargo data.
Yeah, well, it has to do with new containers. And, Jason, you got to see this thing because this is pretty dramatic. We're potentially going to take the number of shipping containers to a new all-time high. Look at that. Potentially add 2 million containers. That would be an 11% increase over the next year and a half. You add to that the fact that 3 of the major shippers are all taking 10 new ships. I mean, have we learned anything here in this whole experience of the past 3 years?
You know, I think the best way to look at this is we are in an economic expansion. You know, to see shipments and to see shipping tanks actually expanding or taking on more capacity at this point in time is probably the right thing to be seeing. We should be seeing businesses expanding. I think they're doing so hesitantly. I think they are doing it, but they're doing so hesitantly, and that's what's holding us back at this point.
Got to run. Jason, thank you as always. Jason Pride joining us there.
Thank you, Carol. Thank you, Matt.
Thanks.